Welcome to Debt
It's
Matters.
good to be here.
We're looking at something very specific today, a situation unfolding in Worcestershire, in England.
Hmm.
Now, on the surface, it might seem like just a local news story, but if you peel back the layers a little, it really gives you a blueprint for how local government finance is starting to strain right across the country.
It does.
The headline itself is quite simple. The local council there has been given permission by central government to raise its council tax by up to 9%. That's starting in April 2026.
9%. I mean, that's a number that really makes you stop and think.
It does, because normally there are rules, right? There's supposed to be guardrails in place for this sort of thing.
There are caps. The standard limit is 5%. If a council wants to go above that, they legally have to put it to a referendum. They have to ask the residents directly, are you okay with paying more?
But that's not happening here.
No. In this case, they've bypassed the voters. They've gone straight to the government and asked for special permission to break that cap.
So the guardrails have just been lifted.
They've been removed, and that's because the financial situation is, well, it's critical. When you see a council asking to hike taxes by almost double the normal limit, that's a real distress signal.
Right.
It means the standard ways of doing things, the money they get in grants, the money they can raise through normal taxes, it's just not enough anymore to keep things running.
And this isn't just a number on a spreadsheet, is it? For people who actually live in Worcestershire, this is a fixed cost going up. It's not like a streaming subscription you can just cancel if it gets too expensive.
That's the absolute key distinction. It's what we'd call inelastic. You have to pay it. It's a direct increase in the baseline cost of living for every single household in that area.
And 9% is a big jump.
It's a hefty jump, especially when you think that wages for most people aren't exactly growing at that same rate.
So we're going to unpack the mechanics of all this. We'll look at why it's happening specifically in Worcestershire, but then, more importantly, what happens next. How does a tax rise like this change the way debt is collected? What does it do to the local economy? And, if you're the one on the receiving end of that bill, what are your options, really?
It connects the big picture to the small one, doesn't it? The council's balance sheet problems, they eventually land right on the residents' kitchen table.
Exactly. So let's start with this case study. Worcestershire County Council. As we said, a 9% rise.
And you need context for that number. Most councils are sticking to that 5% cap because, well, they have to. Worcestershire's a real outlier here.
They're not completely alone, though.
Oh, no, they're not the only ones in trouble. We've seen other areas get approval for rises of, say, 6.75%, 7.5%, but Worcestershire's is currently the largest approved increase in England.
It's the sharp end of the wedge, then.
It really is, and it makes you ask why. I mean, how does a council get into a position where it even needs to ask for something like this?
Well, looking into the details, the council, which is run by Reform, it's worth noting, has also applied for permission to borrow a huge amount of money. £71 million.
And that $71 million, to be clear, isn't for, a shiny new leisure center or fixing the roads.
Yeah.
It's for what's called a capitalization direction.
Okay, you're going to have to explain that term.
Well, usually, councils aren't allowed to borrow money to pay for their day-to-day running costs. You can get a loan to build a school. That's a capital investment. But you can't borrow to pay the electricity bill for that school. The books have to balance every year.
Right.
A capitalization direction is basically the government saying, okay, you're in such a bad state that we're going to let you bend the rules. We'll let you treat your everyday running costs as if they were a long-term building project. It lets them borrow against the future just to stay afloat today.
It's like taking out a mortgage to pay for the groceries.
That's a perfect analogy. It's exactly that. And the reason they're having to do this is to avoid what's effectively bankruptcy.
Now, we hear this word bankruptcy used with councils, but it's not quite the same as a company going bust, is it?
No, not at all. A council can't be liquidated. What happens is the chief finance officer issues what's known as a Section 114 notice.
And that does what?
It freezes all new spending, instantly. The council is forbidden from committing to anything that isn't a bare minimum statutory service. So Worcestershire is trying to avoid that nuclear option by borrowing this $71 million.
And the main reason for all this debt seems to be something called historic send deficits. We see that acronym a lot in local government news. SEND.
Special educational needs and disabilities. This is probably the single biggest point of pressure in local government finance across the whole country right now.
Why is that specifically?
It really boils down to a mismatch between what councils are legally required to do and the funding they get to do it. So, by law, the council has to provide support for children with complex needs. That could be anything from specialized transport to school, one-to-one support in the classroom, or even placements in very expensive private specialist schools.
These are essential services.
Absolutely essential.
Yeah.
But the demand for them, for these support plans, has just exploded over the last decade. And while the funding from central government has gone up, it hasn't gone up anywhere near enough to cover the actual cost. So councils have been overspending in this one area year after year.
So where was that money coming from if they didn't have it?
For a long time, the government allowed a sort of temporary accounting trick. They let councils put these specific deficits into a separate pot, almost pretending they didn't exist on the main balance sheet.
Right, kick the can down the road.
Pretty much. But that arrangement is now ending, so the bill has finally come due. Worcestershire has this huge pile of historic costs that it now has to clear from its books.
So to put it simply, residents are now facing a 9% tax hike to pay off a debt that was built up because the council was legally forced to provide services that it wasn't fully funded for.
That is a simplified version, but yes, that's the core of it. A systemic issue and being fixed at the local level by the local taxpayer.
Let's shift to the impact then. It's April 2026. The new bills start landing on doormats. What does a 9% rise actually feel like for a family?
Well, it's different for every band, of course, but let's just think about the psychology of it. We're in a climate where the cost of living is still a major concern. Energy, food, it's all still expensive.
People have already trimmed their budgets, haven't they?
Exactly. For many households, there's no fat left to trim. So when a fixed cost like this jumps by 9%, it's not eating into savings. For a lot of people, it's eating into the money that's meant for other essentials.
It pushes them into the red.
And this is where you start to see the behavioral economics of debt play out. When you don't have enough money to pay every bill, you start to triage. You have to decide who gets paid now and who has to wait.
And it's guessing the mortgage or the rent payment is always number one.
Always. Because the consequence of not paying that is losing the roof over your head. Then it's usually energy bills, because you need to keep the lights on. Then food.
So where does council tax fit into that list?
Often it slips down the priority list. There's this perception that the council is a bit slow, a bit bureaucratic. People think, it's the government, they won't send the heavies round tomorrow. I can probably push this back a month and catch up later.
And in this specific situation, that's a really dangerous assumption to make, isn't it?
It is the most dangerous assumption you can possibly make. You have to remember the context we just discussed. This council is not sitting on a big pile of cash. They are 71 million pounds in the hole. They are, frankly, desperate.
And a desperate creditor is an aggressive creditor.
Precisely. They do not have the luxury of letting people pay late. They have their own cash flow crisis to manage. This means their collection intensity, as we might call it, is going to be turned up to the maximum setting.
Okay, let's walk through what that intensity actually looks like. I think people have this vague idea of getting a few reminders, but they don't appreciate how mechanical and how fast this whole process really is.
It's like a conveyor belt, and once you're on it, it moves you forward very, very quickly.
So, month one, you miss your April payment. Maybe you just forgot. Maybe the money wasn't there. What happens first?
Within a week or two, you'll get a reminder notice. This is the softest touch you are going to get in the entire process. It just says, you missed a payment. Please pay it within 7 days to get back on track.
Which seems fair enough, but if I'm juggling bills, I might put that letter on the pile and think, okay, I'll just pay double next month.
And that is the trap. That's the critical mistake, because if you don't pay within those 7 days, or if you pay late again at any point in the year, you lose the legal right to pay by installments.
I want to pause on that because that is a detail that I think almost everyone misses. You lose the right to pay monthly.
Yes. The ability to pay your council tax in monthly chunks is a concession, legally speaking. It is not a fundamental right. If you show you can't stick to the agreed schedule, the council is fully entitled to withdraw that concession.
So that takes us to month two. What happens then?
In month two, you get a final notice. And this isn't a letter asking for the, say, 150 pounds you missed. This is a letter demanding the entire year's council tax, the full amount.
Wow.
Up front. And you have 7 days to pay it.
That's catastrophic. If I couldn't find 150 pounds last month, I am definitely not going to be able to find 1,800 pounds this week.
Exactly. And that's when the real panic starts to set in. But you're now locked out of the normal payment system. You can't just go online and pay the monthly amount anymore because the computer system says you owe the full balance.
So you're stuck. And then month 3 arrives.
Month 3 is the legal escalation. The council goes to the magistrate's court and applies for something called a liability order.
A liability order. That sounds very serious.
It is the golden key for the council. It's a court order that officially confirms you owe the debt and gives them the power to use much stronger enforcement methods.
So does this mean I get a day in court? Do I get to stand up and explain my situation, that my car broke down or I lost my job?
In theory, yes, you can attend the hearing. In practice, almost nobody does. And even if you did, the magistrate's hands are tied. The law is incredibly specific.
How so?
The only valid legal defenses are, I've already paid it, or I'm not the person who is liable for the tax on this property. The argument, I can't afford to pay it, is not a legal defense.
So these court hearings.
They're bulk processing events. The council will present a long list of names, sometimes hundreds or even thousands at a time, to the magistrate. The magistrate asks if the checks have been done, the council says yes, and the magistrate signs the liability orders. The whole thing can take just a few minutes.
The rubber stamping exercise.
Effectively, yes. And the moment that stamp hits the paper, costs are added to your debt. So now you owe the full year's tax, plus the cost of the court summons, plus the cost of the liability order itself. You're digging a deeper hole just by standing still.
And once the council has that liability order, what can they do with it?
Their toolkit becomes much bigger. They can get an order for your employer to deduct the money directly from your wages. That's called an attachment of earnings.
So my boss finds out I'm in debt.
Yes, which for many people is deeply embarrassing and adds a whole new layer of stress. They can also take deductions from benefits like universal credit or, and this is the one people fear most, they can pass the debt to enforcement agents. Bailiffs. And that's when the costs really start to spiral. The second the file is passed to an enforcement agency, a £75 compliance fee is added to your debt. If they then have to visit your home, another £235 is added, plus a percentage of the debt on top of that.
So let's just recap that timeline. You miss one payment in April. By July, you could owe the full year's tax, plus court costs, plus hundreds of pounds in bailiff fees, and have people knocking at your door.
That is the timeline. It is incredibly rapid, it's highly automated, and it is unforgiving. And with a council like Worcestershire, one that is desperate for every penny, you can be sure they will be moving as fast as the law allows them to.
That's the impact on the household.
Yeah.
But we need to talk about the wider economic effect, too. You can't just pull this much money out of a local community and not have consequences.
No, absolutely not. Money has what we call velocity. It moves around an economy. You earn a pound, you spend it at the local cafe. The cafe owner then uses it to pay their staff. The staff member buys a sandwich from the shop next door. That £1 does a lot of work.
But council tax acts like a financial black hole.
It acts as an exit point for that money. When you pay the council, especially when that money is being used to service old debt or pay for statutory care that isn't circulating locally, it's effectively removed from the high street.
So if my bill goes up by, say, an extra £200 a year,
that is £200 you are no longer spending on discretionary things. You cut back on getting a coffee on the way to work. You put off getting the car serviced for another month. You decide not to buy those new shoes for the kids.
And the local businesses feel that.
Immediately. The small businesses, the sole traders, the pubs and cafes, they are on the front line. They feel the chill first. Their takings drop because their customers are simply poorer.
It goes deeper than just people buying less stuff, though, doesn't it? It must affect how businesses pay each other.
Yes, this is the B2B, the business-to-business contagion effect. So let's say you're a local plumber. You do a job for a client. You send your invoice. But that client has just had their new higher council tax bill land on the mat, and they're panicking about cash flow.
So they pay you late.
They stretch your payment terms. Instead of paying you in 7 days like you asked, they take 30, maybe even 60.
But the plumber still has bills to pay. Materials, van insurance.
And pay their suppliers. So now the plumber has a cash flow problem. They can't pay the builder's merchant on time. The merchant then struggles to pay the delivery company. It creates a chain reaction of late payments that ripples through the whole local economy.
And you tend to see this happen at a specific time of year.
Yes, there's often a real credit crunch in late spring. April and May are when those new bills land and households start to tighten their belts. By June, that lack of cash has worked its way all the way through the local supply chain.
It shows a fragility in the system that we don't often acknowledge. We think of our own finances as being separate, but we are all connected by these flows of payments.
We are. And one broken link, or in this case, one 9% tax rise, puts a strain on every other link in that chain.
So we've painted a pretty stark picture here. A big tax rise, a council under pressure, a very fast enforcement process, and a squeezed local economy. It's a lot to take in. But the point of this is to give people tools. We need to talk about what you can actually do about it.
And we should look at it from both sides of the coin. The person paying the bill and the person trying to get paid. The payer and the creditor.
Let's start with the payer. You live in Worcestershire. That letter arrives in April. The number on it is huge, and you know you can't pay it all. What is rule number one?
Rule number one is very simple, but for many people, it's the hardest thing to do. Do not ignore the post.
Why do you think that's so hard for people?
It's a basic human anxiety response, isn't it? The ostrich effect. If I don't open the brown envelope, the problem inside isn't real. But with this kind of legal process, silence is fatal. The system is automated, and if you don't engage, it assumes you are willfully refusing to pay. It treats you as a hostile debtor.
So you have to engage with it.
You have to interrupt the conveyor belt. The very first moment you realize you're going to struggle to pay, you need to contact the council.
But what can they actually do? If they're as desperate for money as we've said, are they even going to listen?
They have to. They have a duty to, and they have discretion. If you call them before it gets to the liability order stage, they have options. They can often agree to what's called a special payment arrangement.
And what would that look like in practice?
Well, they might agree to let you spread your payments over 12 months instead of the standard 10. That immediately lowers your monthly payment. Or if you've had a short-term crisis, like being made redundant, they might agree to a temporary reduction. But they can only offer these things if you're actually talking to them.
And it's always worth checking if you're entitled to any support, isn't it?
Always. You should immediately check if you're eligible for council tax support or any other reductions. A surprising number of people qualify for at least a partial discount, but never apply because they assume they won't get it. A single-person discount, for example, is 25% off right away.
Okay, what about prioritization? We said earlier that people under pressure often pay the wrong bills first. Where should council tax rank in that list?
It has to be treated as a priority debt. In the hierarchy of who you pay, it sits right there at the very top, alongside your rent or your mortgage.
Above things like credit cards and personal loans.
Far, far above them. If you don't pay your credit card, the consequences are a bad credit score and some strongly worded letters. It takes months, sometimes years, for them to take any serious legal action. If you don't pay your council tax, as we've seen, you can have bailiffs at your door in 90 days. The consequences of non-payment are faster and much more severe.
I want to run a scenario by you that I think is really common. What if you're already in trouble? You're still paying off arrears from last year, and now this new, much higher bill lands. What do you do then?
This is where you have to be really strategic. The natural instinct is to try and throw whatever spare cash you have at the big old debt from last year. But that's usually the wrong move. The correct strategy is to prioritize paying the current year's bill first.
Why is that?
Because you have to stop the problem from getting worse. You need to stop the creation of a new debt. If you pay off some of the old debt but miss your new April payment, the council will just start a whole new enforcement process for the new year. You'll get a new summons, a new liability order, and a new set of court costs.
So you end up fighting a war on two fronts.
Exactly. You have to stabilize the present. Make sure you pay the current year's installment to keep this year's account clean. Then, at the same time, you contact the council to negotiate a separate, affordable payment plan for the old arrears. Don't let the current year collapse while you're trying to fix the past.
That's incredibly important advice. Stop the bleeding first.
That's the principle.
Okay, let's flip the table now. You're a business owner in Worcestershire, a plumber, a graphic designer, a local shopkeeper. You know your customers are about to face this squeeze. You know cash is going to get tight for everyone. How do you protect your own business?
You have to get back to basics and tighten them up. Credit control isn't just a term for big corporations. It's an essential survival skill for every small business.
Where's the starting point?
Remove all friction from your payment process. When you send an invoice, make it absolutely perfect. Is the customer's address correct? Is the purchase order number on there if they need one? Are your bank details clear and easy to find?
Don't give them an excuse to pay you late.
Precisely. If a customer is looking for a reason to delay a payment, A small query or a typo on an invoice is a gift to them. Don't give them that gift.
What about payment terms?
Shorten them if you can. If you typically give customers 30 days to pay, think about moving to 14 days or even 7 for new clients. You need to get your invoice to the top of their payment pile before all the other bills land.
And the process for chasing late payments. We often talk about a framework. Friendly, firm, final.
It's a simple structure, but it works because it's consistent. You don't wait until an invoice is a month overdue. Step 1, friendly. A couple of days after the due date, just a simple email. Hi, just checking you received this invoice. It's non-confrontational and allows them to save face if they've genuinely forgotten.
And if that doesn't work?
Step 2, firm. A week later, the tone changes. This invoice is now overdue. Please arrange for payment immediately. Step 3, final. If this invoice is not paid by set a clear date, we will be forced to take further action to recover the debt.
And the key is you have to stick to those deadlines.
Absolutely. If you set a final deadline and then you let it slide by a week, you have just taught your customer that your deadlines don't mean anything. Consistency is everything.
There's also a legal tool businesses can use to do with charging interest.
Yes, statutory interest. Under the Late Payment of Commercial Debts Act, if you're a business, you are legally entitled to charge interest and a fixed compensation fee on any late B2B payments.
But should you actually charge it? It might upset a good customer.
You don't have to enforce it every time, but what you absolutely should do is put a line in your standard terms and conditions and on the bottom of your invoices stating that you reserve the right to charge it.
Yeah, it's a signal.
It's a powerful signal. It tells your customer that you are a professional business, you know your rights, and you take being paid on time seriously. When that customer is looking at a pile of bills and deciding who to pay first, you or the supplier who never chases, they are more likely to pay you.
It's all about moving yourself up their priority list.
That's it. In a cash-strapped economy, the squeaky wheel gets the oil. You need to learn how to squeak, politely but firmly.
And the timing for putting all of this in place.
Do it now. Don't wait until April when the crunch hits. By then, it's too late. You need to get your systems in order and train your customers to pay you on time before the pressure really mounts.
It really does highlight how interconnected everything is. A decision made in a council meeting about a historic deficit creates a shockwave that travels through every household and every local business.
It does. It shows you the fragility of the whole system. The council is squeezed, so they squeeze the resident. The resident is squeezed, so they squeeze the local business.
And the only real way to navigate that is to understand the rules of the game you're playing.
That knowledge is the only leverage you have. If you understand that 3-month timeline, you know when you need to act. If you understand the priority of debt, you can protect your home. If you understand the basics of credit control, you can protect your business.
You can't stop the 9% rise from happening, but you can control how you react to it.
That is the reality of the situation.
And that's where we'll leave it. This has been a pretty heavy topic, but hopefully understanding the mechanics behind it all makes it feel a little less overwhelming.
It's always better to face the machinery with your eyes wide open.
Couldn't agree more. Thank you for listening to Debt Matters.
Goodbye. Goodbye.